Buffett didn't miss out on the SpaceX IPO. He didn't miss it because he's 95. It's because the business he built, Berkshire Hathaway, has been designed to say no to offers just like SpaceX. We're going to walk through the audit, and by the end of this breakdown, you will understand 3 structural rules that Buffett baked into Berkshire, rules that stop them from investing in SpaceX, and also why you should even care. The primary pattern here, it's much more serious than most analysts are admitting. You're here to learn business lessons through audits. Let's dig in. In June 2026, SpaceX IPO'd, minting Elon Musk as the world's first trillionaire. Let that land. It took the entire global economy until the steam engine boom of 1820 to generate 1 trillion in global domestic product, GDP. The United States became the first country to hit 1 trillion in domestic GDP in 1969. Musk, he crossed that threshold in less than a career. Warren Buffett, the Oracle of Omaha, has publicly praised Musk and his businesses. Berkshire Hathaway is sitting on $397 billion in cash, and yet they did not invest. The question isn't whether they could have. They obviously could have. It's why the system that Buffett built was designed to say no. Lesson number 1, the known quantity. Buffett has famously said that us mere mortals, that we should stick with an index fund and call it a day. The advice reveals something a little bit deeper than humility. It reveals his core investment rule. Buy only what you can model. A known quantity, predictable earnings, durable moat, decades of data, and then hold that investment for a lifetime, if possible. Now, I want you to apply that rule to SpaceX. This company has no public earnings history, a valuation built on future Mars revenue, and satellite margins that, well, they really don't exist yet. A business model where the moat is still theoretical. SpaceX isn't just outside the circle of competence, it's outside the entire known quantity framework. Buffett's first structural rule simply rejects it before the conversation can even start. Lesson number 2 is the rule that Buffett almost never talks about publicly, and it's the one that would have stopped him even if SpaceX passed the known quantity test. So lesson number 2, it's called the margin of proof. Berkshire didn't skip SpaceX because of its bleeding capital. Look at what Berkshire owns. Coca-Cola, See's Candy, Geico Insurance. These weren't startups, they were proven machines. Decades of cash flow. Products customers already bought every single day. In some cases, the fundamentals were broken, maybe neglected. Buffett's genius wasn't betting on unproven ideas. It was spotting proven businesses that were run below their potential and then fixing the operation. Berkshire doesn't invest in the possibility of a moat being created. It invests in a moat that already exists. And then it deepens it, it widens it. SpaceX simply doesn't fit. Not because the business is bad, because the proof, it's not there yet. And even if SpaceX closed both of those hurdles, the known quantity and the margin of proof, there's a third structural rule that would have stopped Buffett, and it did stop Berkshire. And that one, it's actually got nothing to do with SpaceX. Now, you've earned the real answer. And if you've made it this far, subscribe to keep these audits coming, and the algorithm respects alike. Lesson number 3, we're calling it the leverage ceiling. Here's the number most people miss. Berkshire Hathaway, they're holding their cash, that nearly $400 billion in cash, in government bonds and treasury bonds, not stocks, not startups, government debt. The reason is that the Buffett Indicator, the ratio of total market cap to GDP, here in 2026, it's at an all-time high. Over 6 decades, when the market runs this leveraged, the Oracle has demonstrated that correction is not a possibility. It is a pattern. History doesn't bet on exceptions, and neither does Buffett. His cash is hardly being deployed right now. Not for value stocks, not distressed assets, and certainly not a speculative IPO, no matter how brilliant the founder might be. And this is the leverage ceiling. When the indicator breaches a threshold, Berkshire locks. The system overrides the opportunity. It doesn't matter how good SpaceX looks, the checkbook remains closed. Buffett didn't skip the SpaceX IPO because he's 95 and retired. He skipped it because the system that built Berkshire Hathaway was designed to say no to a company exactly like SpaceX. Profit? It's not a happy accident. It is a system.